Good afternoon, everyone. Tim Herriage here, Ternus Lending. Wanted to go ahead and get started. We're recording this, so anyone that's late is late. The topic of this webinar is demystifying DSCR. And in my 10 years of originating institutional quality DSCR paper, I've learned that it's one of the most confusing things. And a couple weeks ago, I mentioned to a buddy on Facebook that we were starting to see some 5% flat interest rates. And several people called me and told me that could not be true. And that's not what they got quoted. And it just came to me that most people just don't understand the levers that are available when it comes to obtaining either the best price or the most proceeds on a loan. And it would be good to take a minute to just kind of dive through some of the scenarios and hopefully explain it a little bit more. So a little bit about Ternus. We started this January. Those of you that know me and my history know for the last several years I was the executive director of RC & Capital. And 10 years ago was one of the founders of B2R Finance, which became Finance of America. Ternus is a balance sheet lender in 8 states. What that means is we loan our own cash in 8 states. Those states are Texas, Arkansas, Oklahoma, Missouri, Ohio, Tennessee, Georgia, and North Carolina. Those states are not listed on the slide because we are rapidly expanding the states that we service. On those 8 states, we do offer a 6-month, 100% financing fix and flip product, as well as a 30-day purchase price only wholesale loan for those of you that routinely purchase the property, clean it out, and sell it as is. And then we also offer transactional funding. We do have access to other fix and flip loans through our institutional partners, and typically, depending on the scenario, can find you something in about 40 of the 50 states. On the long-term rental loans or the DSCR loans, which is really the topic of today's conversation, we have partnerships with institutional investors, insurance companies, hedge funds, where we're able to deliver these loans. And if you're, this education is free, obviously, but if you're the type of investor that values speed, transparency, and dependability over maybe, a quarter point of rate, or you're shopping for certainty versus price, you're the type of customer that we want to help achieve your goals. So a little disclaimer, there's nothing in this presentation that is an offer to lend. Many of the products we discuss have different variable availability by state. We do not provide consumer loans or personal financing. We only offer business purpose loans for legally established U.S. business entities and U.S.-based IRA accounts. So each credit proposition is contingent on due diligence, underwriting, approval process, and qualification for financing does not guarantee the most favorable rates or terms. So there you have it. I like to start off with this because as finance folks, we tend to talk about BIPs. And I know plenty of my friends and colleagues in this industry that have bought a lot of houses. And when I say 20 BIPs, they look at me as if I'm crazy. And a mentor of mine once said, Tim, don't tell me BIPs, tell me dollars. You can't buy a coffee at Starbucks with a BIP. So I'm going to say BIPs a lot in this presentation, so I thought I would just go ahead and throw this slide in there. 1% is also 100 basis points. In finance, often larger numbers require smaller dividers, so a lot of finance folks talk about basis points instead of percentages. You'll see it abbreviated as BPS, which is basis points. Finance professionals often call it a BIP. So 20 BIPs is the equivalent to 0.20%. Those of you that are finance folks on the call are probably laughing right now because you know what it's like to have to explain this. A lot of people also don't know what a loan level price adjustment is. A loan level price adjustment is the way loan purchasers adjust the risk of the loan by utilizing price. So there are often small nuances that change your pricing, but what we see specifically in the DSCR space is there's a cumulative effect of all the decisions made in the loan pricing process that oftentimes take a base rate of 5% and turn it into a 6.5% interest rate, and the customers and the investors find themselves a little bewildered. So we're going to look at LLPAs. We're going to talk about FICO. I'm going to focus really on 5 sections: FICO score, loan to value, the debt service coverage ratio, the transaction type, and prepayment penalties. There are some other drivers in certain points, but I find these to be the big 5 that really modify your pricing and, in essence, confuse customers. So let's talk about key criteria and really dive into how it impacts loan level pricing. I think one of the greatest things we can do as entrepreneurs, as real estate investors, is really help our customers or our audiences, for those of you that have followings, or yourself as a borrower, improve your FICO score. Oftentimes it's confusing for customers because they hear us say that a DSCR loan doesn't revolve around your personal income. It doesn't revolve around your personal W-2. It doesn't revolve around your personal financial statements or tax returns, but your personal FICO score is probably the single largest driver. And that is because IT's chatting with me. That is because it is one of the prime indicators of risk. So even though you are borrowing under Tim's house buying LLC, if Tim Herriage is the guarantor or the person that's personally guaranteeing the loan, that is seen as a large driver of risk. And so it's one of the first things we look at. Generally, if you're a 780 or above, you're going to get the best pricing. There are some scenarios where you need an 800 to get the best pricing, but I would say 90+% of the loan level pricing adjustment, 780 plus, is really the sweet spot where you're getting the best deal. And you may not believe, understand, or agree that there's a big difference between a 779 and a 780, but there is. You may not agree that there's a big difference between a 759 and a 760, but there is. And there is because as a lender, we have to have a programmatic way of pricing these loans that we share with the loan purchasers, typically large insurance companies, hedge funds, large banks, and they're buying these $5, $10, $50 million at a time. They're not buying one individual loan. So for me, most lenders do not have the ability to say, hey, Mr. Loan Purchaser, this customer has a 759. I want to give him or her the pricing of a 760. As a matter of fact, when I say most, I mean none. There is no one in the industry I'm aware of that can get that waiver, because ultimately all of these loans, 200 to 300 million at a time, are bundled up by insurance companies and hedge funds and securitized on Wall Street. And then there are bonds sold. So the program is the program. And, oftentimes it's really, I say sad because I'm a borrower and investor too. It's really sad when you have that month where your Amex is really high because you have 3 rehabs going on and your credit comes in at a 750 instead of a 785 like it was last month, because oftentimes you can see a 15 to 30 basis point increase in your rate, and it's really just because you may be 5 points away from the next pricing bucket. So, the real actionable insight, the real advice here is make sure you're taking care of your credit. Make sure, if you're someone like me that always has something hitting his credit between the Amex for Ternus or the Amex for one of my house buying companies, or a line of credit that I used a lot before I refinanced a short-term rental. All of these things hit your credit, and I know it can be really frustrating. So and especially if you get, I think, if you've been in this business long enough, you've had that one water bill on the house that you bought 5 years ago that they never mailed to your office. They only mailed to the property, and they mailed collections notices to the property after you sold it, and you never got the mail. And then you find out about it once it hits your credit as a collections account for $30. It's probably the most maddening thing I ever had was a $3 collection account on a energy bill for a house I had flipped that I got in a hurry, and this was 10, 15 years ago, and I put the utilities in my personal name because I was in a hurry. So I recommend you invest in credit monitoring. I recommend you keep your credit frozen when you can. Companies like LifeLock and Lexington Law Firm have worked well for me and my wife. And if you are like a lot of our customers, you've got a little bit of bruised credit and you're in the mid to high 600 range, investing in credit repair can lower your rate on DSCR a full 100 basis points. So it is important. I hate seeing someone that's 5 points away from getting the deal done or not. So I highly recommend you watch that. Loan to value is another one of those tricky things. Oftentimes we hear the teaser rate of 5%, and we want 5%. But we also want an 80% refi. Well, that 80% refi is a higher loan to value. And I just challenge you to look at it as if you're buying a house. If you're buying a house for 60 cents on the dollar, all in, you're protected. There's a lot less risk on that house. If you're buying it at 80%, if you're like me, you'll do that sometimes, but you're going to go sharpen your numbers. You're going to get a couple bids on the construction. You're going to really make sure that this thing can't go sideways, because as a lender, if I'm at 80% on a $100,000 house and that house experiences a 10% decline in value, right? Now I have loaned you $80,000 on a $90,000 house. So my loan to value just went from 80% to 89%. This is why loan to values tend to get a higher increase. And depending on which program we put you in, the cutoff point may be 65%. So if you're really rate sensitive, understanding with your lender that asking for a 64% loan may significantly lower your rate. Oftentimes, if you can get to a 59% loan or less, remember 59 is most likely treated the same as 50, right? And the difference between a 59 and a 75 LTV loan many times is well over 50 basis points. So I think if you have the equity and you don't need the cash out, and rate really matters to you, I always highly recommend talking to the loan officer or the lender or your broker and really diving into what you need to do versus what you want to do. Because we all want the 80% cash out, and we all watch the videos that says, I'm using other people's money and I'm only paying 6.5% on that extra $50,000, and I know I can make more than 6.5%. That's great. And if that's your decision, roll with it. But if you're one of the investors out there that the rate really matters to you, you are cash flow sensitive, you really want the lowest rate with the high, so you can have the highest cash flow, get to understand these pricing buckets. Because oftentimes, going with a lower loan amount can lower your rate enough. We'll talk about the waterfall effect, that your debt service coverage ratio improves. And so you're getting better pricing, just not only from the lower loan to value, but also from the higher debt service coverage ratio. And that's, we'll get into this real quick. Transaction type matters. Think of it as if it's your money. And someone comes to you and says, I'm about to buy this house, which you can buy a house that's kind of rent ready on a DSCR loan and put 20% down. Well, at that point, you're saying, Tim, I want 100,000, but I'm putting 20 in as well. So at that point, we're kind of partners in the deal. We feel like I'm investing in the transaction, you're investing in the transaction. It's a lower risk. You have skin in the game. A rate and term refinance where you're not getting cash out, and just so you know, there are plenty of programs out there where on the rate and term, we can actually include your closing costs and some of your other costs that aren't like your purchase closing, points you paid. It's not only the loan amount on the payoff. There's some other things that can be rolled in. I'm not diving all the way into the details on that because ultimately it's going to depend on your credit score and your loan to value and the product that you're looking for. When I say product, if it's a short-term rental loan, or if it's a rural loan, or if it's a pad split loan, or if it's just a cookie cutter bread and butter, 322 ranch style rental property in a suburb. And then cash out is the most risky, because at that point you're coming to me and you're saying, Tim, I own this asset and I want all the money I have invested in it out, and then I want more money out. And the thing is on these cash out loans, there's no restriction on what you can use that cash out for. So if you pull $50,000 more than you ever put into the house out, which by the way, I'm not knocking, I do it all the time and I love it. You can use that to pay your personal bills. You can use that, one of the examples we always use, to buy jet skis. There's no real restriction on what you're using that cash out for. So it's more risky. It doesn't stay in the deal. So the price, risk-based pricing, the price for that, the interest rate, goes up 25 to 50 basis points. So I think the actual insight here is you really need to consider whether you need cash out, or if a rate and term just to recoup your out-of-pocket cost is better for you, because on a rate and term, you're going to see significantly better pricing. And that pricing rolls directly into the debt service coverage ratio. Because properties, if you have a higher FICO and you're taking a lower loan to value and you're not getting a bunch of cash out and it's a rate and term, see, now we're aligned, right? So now you're looking in many cases at 100 basis points lower loan than if you change some of those other things, sometimes 120. Well, now your rate's lower. Well, if your rate's lower and your rent's high, now your cash flow's higher. So now as a lender, I'm looking at it and I'm thinking, okay, this borrower is cash flowing really good, has a really good credit history, isn't trying to take money and go spend it on other things, and it's a low loan to value. So if we do have a property dip, we're really safe. Now I can give them an even lower rate. So I think it's not just, oftentimes we as investors are in a position where we need the 80 loan to value rate and term refinance so that we can go cash out or get our money back and go buy another property. Just understand that that's one of the most, the 75 and 80 cash out is one of the most risky loans. So that's why it's priced the highest. And it typically impacts your DSCR last once all the other pricing things are done, which then increases your rate even more. And oftentimes that's where we see loans go from at a rate and term with a high FICO, it may be a 125 DSCR that is a really good prime loan with rates in the fives, but as a cash out refi with a little lower FICO, it ends up lowering the DSCR, which then makes it an even more risky loan, which then makes your rate go up even more. And oftentimes it makes it where the loan is what we call DSCR constrained, which means we can't give them the loan amount or even give them a loan because the property doesn't cash flow. And, look, if the loan you're looking for, the property doesn't cash flow, you probably shouldn't do the loan, number one, and you may want to look at selling the property. That's a decision many investors are making right now with the high interest rates, with high property taxes, increased values, increased equity. There are many property and increased interest rates. There are many properties that my wife and I have that are a 3 to 3.5% interest rate, but we're sitting on a couple $100,000 in equity, and they wouldn't even cash flow as a rate and term right now because not only has the value gone up 40% in the last couple of years, so has the interest rate. So balance your portfolio, ask the right questions, go back and forth with your loan officer, loan advisor, or broker, and really do your best to understand what the impacts are on your pricing, and then make the changes necessary to either get better pricing to get the deal done, or at least understand where you're missing so that you're better prepared for the next one. And then obviously there's loan size too. So the median home price in the United States is below $500,000. And that just means half the people in America can afford under $500,000 and half the people are buying above $500,000. So if you are in an area where the loan sizes are much larger, you can expect higher pricing. Interest only is another thing that increases your pricing. California, New York, parts of Florida, parts of Texas now, some of these loans that get above $1 million get pricing hits. And really and truly, if you get up to the 2 million mark, I see a lot of loan level pricing adding 100 basis points in rate, just because if we have a financial setback in this nation, those are the first homes to become unaffordable. So the advice here is understand the loan brackets before you get into a deal that big, and then you're surprised when it comes time to refinance and you can't get a bid, or the rates are significantly higher than you were expecting. This is another one, along with interest only, that I see a lot of customers miffed by. They want optionality. They want to, as an investor, as an entrepreneur, we want to be in control. We want to have our cake and eat it too. And we want to be able to refi the house if we want to. We want to be able to sell the house if we want to. And so we asked for a shorter prepayment penalty. Well, one of the reasons that many times over the last 3 years, the DSCR loans have been actually priced underneath conventional loans as far as pricing levels, is because of the prepayment penalty. So a bond investor, a loan purchaser, they are buying these loans in bulk and they want to know what they're going to make. So if there's a 5-year prepayment penalty, these bond investors can really figure out exactly what they're going to make by investing in that loan. And the bond investors that have been buying like residential mortgages or Fannie Mae, Freddie Mac investor mortgages are pricing in significant refinance risk. Because if you bought a conventional loan as a loan purchaser at 8% 2 years ago, you know that thing's going to get refinanced this year or next. So they were pricing them higher because they need to hit a yield, a certain number. If they're going to buy $10 million worth of loans, they need to feel like really confident they're going to get or if they're going to put $100 million to work in bonds, they want to get $120 million back or something of that nature. So just understand that a lot of investors, a lot of customers, a lot of brokers want to modify and change the prepayment penalty, but that makes the loan maybe not more risky as far as the risk of you not paying me, but it makes the income stream change significantly. It's a lot of us are landlords. It's like if you sign a 5-year lease on residential property or a 2-year lease on residential property, you really know your income stream for the next 2 years. And you may be giving up a potential rent increase, but you're also taking out some vacancy. So sometimes, me personally, I'll take a little bit lower on a 2-year with a well-qualified tenant because I know what my income will be for the next 2 years. And the same thing a prepayment penalty is kind of like a guaranteed term for the loan, because if rates do drop, like everyone on Instagram saying they're going to, typically realtors, if the rates do drop, then you have refinances. And if you were planning on getting 6.5% interest for 5 years and you only get it for 2, you had transaction costs. Now your return is much different. So flexibility is great, but understand it will modify your pricing, and just be aware of the trade-offs. And then also understand that some states, Kansas, New Jersey, etc., have either limitations or restrictions on prepayment penalties. And so a lot of us invest across borders. Just understand that you may not be able to get a loan with a prepayment penalty in certain areas. And so that's going to mean that those loans in that area are priced higher because the prepayment risk or the repayment risk is higher. So what I'm going to do right now is I'm going to tell you there's a Q&A panel inside Microsoft Teams. Feel free to drop a couple questions because we're almost into questions and answers. Now, I've got a couple case studies I'm going to go over with you. But it's hard to demonstrate the impact, and this is why investors call and they say, hey, Tim, what are your rates? Well, I've got to ask you like 15 questions to be honest with you. Now, if you want a dishonest answer, I can say as low as 5%. But if you're in Kansas, that rate does not exist, right? I can say as low as 5%, but if you're in New Jersey, that rate does not exist. I can say as low as 5%, but if you have a 700 FICO score, that rate does not exist. So I bring that up because oftentimes we as investors have been trained to ask about rate first, not to ask about not to share our goal and ask for help achieving it. At the end of the day, you're on the phone with lenders that want to and need to make loans. As a lender, that's how we make our money, right? We need to make a loan that is profitable, that is repaid. That's just like the magic of the business. And so I think, if you look at this little example, then I'm going to go to a different screen in a second, but I'm going to show you the difference between a 60 and a 70 LTV loan, and then the difference in some different FICO scores, even where 10 points of FICO can change the rate, and 10 points of FICO and 10 points of loan to value can literally change the rate 50 to 100 basis points. The FICO alone, in some cases, can change the rate 25 to 50 basis points by just being 10 points lower. So I'm going to get that loaded up. I'm going to stop sharing my screen for a second. If anyone has any questions, you can go ahead and ask. Robert, while I'm loading this up, do you have anything to touch on that I missed or said wrong?
I think you did a great job. I'm anxious to see if we get any questions in the Q&A.
Yeah, I have to load a loan sizer, and I have to shut PowerPoint to get that loaded because there we go. Yeah, I have 97 rentals, but mainly with banks. I feel you there. Lately, we've been turned down because we represent a risk on paper due to reinvesting. How do you keep growing? Raul, what I've always done, well, not always, what I've been doing lately, since we created this product back at B2R 10 years ago, is I tend to want to fill my bank line up on the acquisition side of the business and the stabilization side of the business, and then clear the bank line out. I like to clear the bank line out with a big DSCR loan or a bunch of DSCR loans, and then go refill the bank line. Let's see, we'll go with rate term refi. U.S. citizenship and or foreign nationals both are eligible, but it does modify rate as well. There's a difference between multifamily and single family. There's a difference between condos and single family. There are so many variables that I think that's one of the things that we're doing here at Ternus that I'm really happy about, that we take the time to help you understand the nuances so that you can make an educated decision. There's different pricing between long-term rental, short-term rental, housing assistance vouchers, all of it. There's way too many to list. Some of those other ones have much smaller impacts than the ones that we covered here today. Let's see. But yeah, I mean, you can keep growing with us. We're more than happy to, extend acquisition financing. We're more than happy to work with you on refining those off the bank lines. I think, with a good understanding of the criteria, you can kind of pick what you buy or what you refi off your bank line, and it can make a big difference. So I probably should have filled this out first, but I was hoping that there would be more questions. And there we go.
Yeah, I will throw out, you were talking about FICO a little bit ago. And most of the time, or when you use like one of these free services, you're looking at a little bit of a different FICO than a true credit pull. So you can be misled by, even, if you go to Bank of America or one of your credit cards that's pulling a FICO score for you, it sometimes is not going to match up with what your true FICO and a tri-pull credit score would show.
About that, Robert, that's a great point. The beautiful thing about that is many of our partners now allow us to do soft credit pulls. So, it's nice that you can know what the real score is, so to speak, without having a ding on your credit.
Yep.
All right, so here's one property that I'm actually considering refinancing at the moment. And on the left-hand side, you see this is the exact property. The left-hand side is a 700 FICO score. 760 FICO score. And the right-hand side is an 800 FICO score. So when we talk about levers to pull, right, you really have to understand, you see each column, so I'll show you that. Each column represents a loan amount at a different pricing bucket. And then each row, am I still showing my screen?
I think so.
Sure. Each row represents lender, the points you pay. So you hear a lot about buy downs. So on the left-hand side with the 760 FICO, you can pay 3.5% at 50 LTV and get to a 5 flat interest rate on this house. At an 800 FICO, I'm sorry. Yeah. At an 800 FICO score, you can pay 3.25% to get to a 5 flat. If you want to push the loan value up to 70%, you notice 75 and 80 are not available on this. And that's because it wouldn't cash flow at those numbers. So if you cap out at 70, no points at about a 70% with a 760 FICO, you're at about 6.2, and with an 800, you're 6.15. So very small differences there, and a lot of that has to do with the fact that it's such a high FICO score. But I'll go back to the 760 FICO score. And then I'm going to change this from a rate and term refinance to a cash out refinance. And I'm going to hit the wrong button. So now, all right, I'm not watching the questions, so let me know if it's continue. This is the exact same house. This is the 760 FICO example. And this is the difference between a cash out and a rate and term. So you notice here we're pushing over to 6.4 on the rate and term on the cash out at 75 loan to value. and 6.325 at 70 versus 6.2 at 70 on a rate and term. So in this instance, the rate and term aspect at 70 LTV versus cash out is about 12.5 basis points different. If you go all the way over to the 50 LTV, you notice that it's only 2.5 basis points different. The reason for that is since it's a lower loan to value, the pricing risk goes down. So the difference in program is not as significant. So, and then just to even be more fun, I'm going to take this exact same asset and I'll change the credit score to 700. And now the 75% cash out is 6.8. So it's a 40 basis point increase by going down to a 700 credit score from a 760 credit score. And this is also a really high cash flowing property. If we were to take the DSCR down pretty significantly, lower the rent down to now you're at 6.8 on the 70 LTV bucket and 75 is not available. So, you know, you're looking at 50 basis points more. So I think this is just, you know, one of those things. I mean, it's really like this is one of the reasons people get a little frustrated when we can't tell you your rate on the phone. We can't tell you your rate on the phone because there are so many variables. We'd honestly be doing you a disservice by quoting something because the odds are it would be wrong. We can tell you after we have a couple conversations and quote specific transactions. So, any other questions? Everybody's ready to go home on a Friday. All right, well, folks, I appreciate your time. I know a lot of people just signed up so they can get the recording. We'll send the recording out. I highly encourage you, if you are trying to think this through, call the number on the screen, 214-471-5557, or just email loans@ternus.com. Loans@ternus.com is a group mailbox that's monitored by our virtual assistants and our loan officers all day, every day. And we'll get you some quick quotes. And you have our commitment that we will we won't jerk you around, we won't drag you through the mud, and we'll be transparent. And we'll move as fast as you can move. And that's the last thing I'll tell you before we sign off. One of the worst things that people do in borrowing DSCR money is do not reply to, oh, there's a lot more Q&A that just came in. I just couldn't see it. People don't reply to their lender. People will pay $500, $700. I think appraisals are $800 now, some places. And they'll pay the money and then they won't get the appraiser into the house for 2-3 weeks. You have to provide your legal docs. You have to provide bank statements. You have to provide your lease. You have to provide access on DSCR loans. Now, the Ternus fix and flip loans are completely different. That's not what we're here to talk about. Those are much quicker and much easier. My biggest advice is, time kills deals. And if you're going to start the process, be committed to be responsive. Be committed to be transparent. Oftentimes, investors think that they're going to maybe sneak a creative finance deal through or sneak a second lien through. or not have to explain why they had a tax lien 2 years ago because the tax notice was mailed to a post office box instead of their house. We get all of those things. I promise you, I've probably been in the situation myself, and we can help you get through it. But it's just like having children. If I catch you not telling me the truth, it's completely different than if you come to me with a problem. Because I think, what else are you hiding? What are you not telling me? And that's what our capital partners think too. So if you have a hairy deal, if you have something that is a little less conventional than maybe you think, if you're transparent with us, we will do our best to quickly get you the right answer and be fully transparent with you, so that if we tell you we can do something, we do it. Nobody wants to waste their time, and we don't want to waste your time. We believe in respect here at Ternus, and that goes both ways. So if you're out there and you want to talk this through, reach out. Jim, you ought to call me with that FICO, door count, and loan to value. Yeah, you can get a 5% rate. It's going to depend on if it's rural or not, if it's long-term rental or not. It's going to depend if you want to buy the rate down, or if you want to take, a high 5 rate and pay no points. All of these are options. And our job is to find out what you want. Like, some people want as much cash out as possible and could care less about the rate. Some people want the lowest transaction cost possible with the highest level of optionality. We price loans out every day with a 1-year prepayment and 0 points and interest only. Now, that rate is a high 7, low 8, but we're able to get the customer to the optionality or the loan structure they want. But don't ask for interest only if you don't want it, because it's going to change your rate and then you're going to get discouraged, right? Tell us what you're trying to accomplish. Is it max money, max cash out, lowest transaction cost, highest cash flow, or most optionality? Between those things, we can help you structure the deal, and 9 times out of 10, hit it out of the park. Jim, send me an email. We'll set up a call, and I'll facilitate it with one of our loan officers. Raul, happy to do a one-on-one with you. I'm going to have a loan officer on there because what you guys got to understand is I run the company. I don't run loans. I understand this stuff, but if I quote you, I'm probably going to be wrong. But we've got a team of amazing people that this is all they do every day, and they're probably going to be right. The base rate typically prior to any adjustments, Jaleb, right now, I really feel like if you just took the average of what I'm seeing quoted, it's between 6 1/4 and 6 3/4. Some lenders' base rate is really low, like in the low 5s, but their loan level adjustments make it where the low 5s are almost unobtainable. Other lenders have a base rate of 6.1, and they're really friendly with loan level adjustments that take the rate down. So this
yeah. Tim, go the other way. And for the sake of those that are watching this recording, this is on October 4th, 2024. So those rates that Tim's talking about. But yeah, and the price adjusters go either way. So, if you're looking at something in the 6s, it may not be all that crazy to see it actually wind up at 7 1/4, depending on your situation.
Yeah, and that's a good point. Be careful who you follow financial advice from on Facebook or Instagram. A lot of people are saying rates are going down, going to keep going down. That is not guaranteed. The message we hear right now is higher for longer. So it may be 25 basis points cheaper in December. But what does that cost you in opportunity cost? And what does that cost you maybe in your bridge debt? Because if you're paying 10 or 11 or 12% and you wait an extra 3 months to get that done, is saving a quarter point really that big of a deal? Also, a lot of times, I mean, I can't tell you how many people delay a refi and then the house goes vacant right as they were getting ready to refi. And they got a 3-month lease up and now they can't get it done. So I think the time is now, always. They say date the rate, marry the house. Typically, the people that say that are lenders that want to refinance you, and I get it, right? But I feel like you've got a job to do, and that's turn inventory and turn assets. And we've got a job to do, and that's turn capital. So time it, understand it. I closed on a short-term rental of mine. I had to put $100,000 extra in May, and I was so happy to get a 6.5% interest rate. That rate would probably be 5.75 today. And my wife brings it up, and I don't care because we were paying 10% interest. It would have been another 4 months of 10% interest, and it's a short-term rental that was looking at 12 months actuals as the qualifying criteria for the loan amount, and the house has been vacant for the last 2 months. So, although the rates are better, the property's not cash flowing. So that's the reality behind it. I appreciate everyone's time and attention. Just let us know how we can help. Loans@ternus.com. Call us anytime. We appreciate your business and we appreciate your referrals. Everyone have a great weekend.